I used to think that I was being smart with money. I was saving, I was investing, I felt responsible. But then I realized one simple beginner mistake was quietly costing me thousands of dollars without me even noticing. And here's the scary part. It's the same mistake almost every new investor makes. These aren't mistakes about picking the wrong stock. They're just strategy mistakes, the kind that silently destroys long-term wealth. Today, I'm breaking down 6 beginner investing mistakes that are holding people back for decades and exactly how to avoid them in 2026. Stick around because mistake number 6 is the one that determines whether investing actually works for you or not. Here's the good news. Every single one of these mistakes is 100% avoidable. You don't need to be a Wall Street expert. You don't need perfect timing. You just need the right habits from day one. By the end of this video, you'll have a clear investing playbook that helps you build real long-term wealth without the painful and unnecessary losses that most investors go through. Let's start with the most expensive mistake of all. Investment fees are the silent killers of wealth. Whether you're investing in stocks or real estate, the fees typically look small. They typically look like this, 1% here, 1.5% there, but compounding doesn't just grow your money, it grows the fees you pay too. Let's make this real. You invest $10,000, actively managed fund, 1.5% fee, index funds, 0.04% in fees. Over 30 years, that small fee can eat tens or even hundreds of thousands of dollars from your retirement. And here's the kicker. Higher fees do not mean better returns. In fact, over long periods, low-cost funds often outperform expensive ones. Now, let's say you're investing in real estate. You buy a flip or a rental for $400,000. They want to charge you 2 points, which is 2% of the sales price. Plus, you have all these other fees that go along with it. Underwriting fees, processing fees, title fees, commissions, if it's not covered by the sellers. All of these fees can add up, being over $12,000 and sometimes close to $20-something thousand if you have to pay your own commission. If you want to start making more money per flip or each rental, try to negotiate the fees and as well maybe borrow less money, especially if you're doing flips, because with flips, you're also paying a higher interest on the debt. 10 to 14% at times. So if you borrow less money, you'll end up profiting a lot more money. The market doesn't have to beat you if fees are already beating you. Before you invest in anything, check the expense ratio or your total cost of fees involved. For most beginners, low index funds or ETFs under 0.1 are the smartest moves that you can make. Beginners love asking, should I wait for the dip? Should I wait for the prices to drop? Here's the truth about timing the market. Only works if you're perfect, and no one is. Even professional investors with teams and supercomputers fail at this. The real danger isn't just getting timing wrong, it's missing the market's best days. Missing just the 10 best days over 20 years can cut your returns in half. And those best days, they usually happen right after the worst crashes. This is true whether you're investing in stocks or real estate. I've seen people in real estate be careless on their all-in cost because they think the market continues booming. A perfect example is 2020 to 2022. Especially in the middle of 2022 when the rates started going up, they majorly screwed themselves because the market ended up not going up as fast as planned. If you're aiming to buy rentals, don't listen to the market is going to crash, so just wait nonsense. Because I've seen people sitting on the sidelines forever as they watch prices go up and not realizing had they bought already, they would have had the cash flow and as well appreciation already. Even if the market did crash, if you plan to hold it long term, was it really worth the wait? Buy, hold, and stay invested. Dollar cost averaging removes emotion completely. Invest the same amount every month. Automatically buy more when prices are low, less when prices are high. The market rewards patience, not prediction. This one sounds obvious, but it's incredibly common. People wait, they wait for the perfect time until they feel ready, until they have more money. Meanwhile, inflation is quietly stealing from them every year. That $100 sitting in cash today, next year, it buys less. That $3 smoothie from years ago, now it's pushing to $7. Start now, even if it's $50 or $100 a month. Thanks to fractional shares, there's no excuses anymore. A simple S&P 500 index fund can get your money working instead of shrinking. If you're trying to get into real estate investing, the most common thing that I've seen amongst beginner investors is that they overanalyze and scare themselves out of deals. There's a thin line between being conservative and being too much of a puss. Doing nothing is still a financial decision, and it's still an expensive one. Quick pause. If this is helping you, hit that like button. It really helps the channel. And if you want to see more of these videos, smash that subscribe button. I have a goal of hitting 1,000 subs by February, so it would be greatly appreciated. And now, let's get back to the video. It's not about what you make, it's about what you keep. Short-term trades, higher taxes. Long-term investing, lower taxes. If you're constantly buying and selling, taxes quietly drain your returns. Use tax-advantaged accounts. Roth IRA, 401k, HSA if eligible, and in taxable accounts, hold investments longer than a year when possible. In real estate investing, it's the same concept, but sometimes that short-term gain tax is well worth the profit. However, there are a ton of great tax benefits for holding a long-term rental as well. Tax efficiency is a hidden accelerator of wealth. Friends, family, social media, everyone has a hot stock or their own reason on why certain investing strategies are bad. The same people that told me getting into real estate is a bad idea are the same people trying to find out how I own 23 rentals in 5 years. But none of them are investing for your goals. Blindly following others lead to buying hype, panic selling, emotional investing. Have a simple plan before you buy anything. Answer this. Why do I own this? How long am I holding it? What risk am I okay with? Boring investing beats emotional investing every time. This is the mistake that ties everything together. If you don't know your goal, even market drops feel terrifying. Investing for a house in 3 years, retirement in 30 years require a completely different strategy. Without a goal, you're either taking too much risk or not enough. Set SMART goals instead of I want to invest. Try I want $1 million by age 60, investing $500 a month at 8% return. I want 10K a month in cash flow by 35. A goal turns investing from gambling into a plan.